Welcome back, everyone. I'm Severino, your personal business coach. I have bad news and I have good news. Bad news, most of you will not beat the market if you try to be an investor like we are trying to be, who beats the market so you can compound growth over 20% every year annualized for the next 10, 15 years. The bad news is most of you will not get there. The good news is we have some skills that can be cultivated that nobody can take from you. And today I'm going to share those 7 things with you. Because the really bad news is we will be copied. We are up against hundreds, thousands of other investors. They all have knowledge. They all have research teams. They all have access to the internet. And so many things they can copy from us. But there are 7 things that they cannot copy. So we will lose money if we put our risk onto the wrong things, but we will beat the market if we look at the 7 things that cannot be copied. So let's look at them. I will read to you So You Want to Be the Next Warren Buffett, How's Your Writing by Mark Sellers. Mark has an annualized return of 35% on his portfolio, annualized year over year. And he has around 150 million in assets under management. So that's more than you guys probably have right now in your portfolio. So let's learn something from him, because there are 7 things that cannot be taken from us. What are these 7 things? We want to know them. So first of all, he says, hello everyone who studied at the top universities. I'm here to share with you that you will lose against the market. So don't expect, even if you're studying Charlie Munger, Warren Buffett, Bruce Berkowitz, Bill Miller, Bill Ackman, you will not get their results. And the reason is you have almost no chance to be great. There are probably 1 or 2 people in this room who will end up compounding money at 20% for their career, but it's hard to tell in advance who those will be without knowing each of you personally. On the bright side, although, most of you will not be able to compound money at 20% for your entire career. A lot of you will turn out to be good, above average investors, because you are a skewed sample, the Harvard MBAs. A person can learn to be an above average investor. You can learn to do well enough if you're smart and hardworking and educated to keep a good high-paying job in the investment business for your entire career. You can make millions without being a great investor. You can learn to outperform the averages by a couple points a year through hard work and then above average IQ and a lot of study. So there is no reason to be discouraged by what I'm saying today. You can have a really successful, lucrative career even if you're not the next Warren Buffett. But you can't be an entrepreneurial investor who compounds money at 20% forever unless you have that hardwired into your brain from the age of 10 or 11 or 12. I'm not sure if it's nature or nurture, but the time you're a teenager, if you don't already have it, you can't get it. By the time your brain is developed, you either have the ability to run circles around other investors or you don't. Going to Harvard won't change that, and reading every book ever written on investing won't change that either. As an analogy, think about competitive strategy in the corporate world. I'm sure all of you had or will have a strategy course while you're here. Maybe you'll study Michael Porter's research and his books, which is why I did on my own before I entered business school. I learned a lot from reading his books and still use it all the time when analyzing companies. Now, as a CEO of a company, what are the types of advantages that help protect you from the competition? How do you get to the point where you have a wide economic moat, as Buffett calls it? Well, one thing that isn't a source of a moat is technology, because that can be duplicated and always will be eventually if that's the only advantage you have. Your best hope in a situation like this is to be acquired or go public and sell all your shares before investors realize you don't have a sustainable advantage. Technology is one type of advantage that's short-lived. There are others, such as good management team or a catchy advertising campaign or a hot fashion trend. These things produce temporary advantages, but they change over time or can duplicate it by competitors. An economic moat is a structural thing. It's like Southwest Airlines in the 90s. It was so deeply ingrained in the company culture that no one could copy it, even though everyone kind of knew how Southwest was doing it. If your competitors know your secret and still can't copy it, that's a structural advantage. That's a moat. The way I see it, there are really only 4 sources of economic moats that are hard to duplicate and thus long-lasting. One source would be economies of scale and scope. Walmart is an example of this, as is Cintas in the uniform rental business, or Procter & Gamble, or Home Depot, or Lowe's. Another source is the network effects, like eBay or MasterCard, Visa, American Express. A third would be intellectual properties, such as patents, trademarks, regulatory approval. A fourth and final type of moat would be high customer switching costs, like Paychex or Microsoft. There are only 4 types of competitive advantages that are durable because they are very difficult for competitors to duplicate. And just like a company needs to develop a moat or suffer from mediocrity, an investor needs some sort of edge over the competition, or he'll suffer from mediocrity. There are 8,000 hedge funds and 10,000 mutual funds and millions of individuals trying to play the stock market every day. How can you get an advantage over all these people? What are the sources of your moat? Well, one thing that is not a source is reading a lot of books and magazines and newspaper. Anyone can read a book. It's incredibly important, but it will not differentiate you. So what are the sources of competitive advantage for an investor? Just as with a company or an industry, the moats for an investor are structural. They have to do with psychology. And psychology is hardwired into your brain. It's a part of you. You can't do much to change it, even if you read a lot of books on the subject. The way I see it, there are at least 7 traits that great investors share that are true sources of advantage because they can't be learned once a person reaches adulthood. In fact, some of them can't be learned at all. You either are born with them or you aren't. Trait number 1 is the ability to buy stocks while others are panicking and sell stocks while others are euphoric. Everyone thinks they can do this. But then when October 19, 1987 comes around and the market is crashing all around you, almost no one has the stomach to buy. When the year 1999 comes around and the market is going up almost every day, you can bring yourself to sell, because if you do, you may fall behind your peers. The vast majority of the people who manage money have MBAs and high IQs and have read a lot of books. By late 1999, all these people knew with great certainty that stocks were overvalued, and yet they couldn't bring themselves to take money off the table because of the institutional imperative, as Buffett calls it. Second character of a great investor is that they are obsessive about playing the game and wanting to win. These people don't just enjoy investing, they live it. They wake up in the morning and the first thing they think about while they are still half asleep is a stock they have been researching, or one of the stocks they are thinking about selling, or what the great risk of their portfolio is and how they're going to neutralize that risk. They often have a hard time with personal relationships because though they may truly enjoy other people, they don't always give them much time. Their head is always in the clouds dreaming about stocks. Unfortunately, you can't learn to be obsessive about something. You either are or you aren't. And if you aren't, you can't be the next Bruce Berkowitz. A third trait is the willingness to learn from past mistakes. The thing that is hard for people and what sets some investors apart is an intense desire to learn from their own mistakes. And so they can avoid repeating them. Most people would much rather just move on and ignore the dumb things they've done in the past. I believe the term for this is repression. A fourth trait is an inherent sense of risk based on common sense. Most people know the story of long-term capital management, where a team of 60 to 7 PhDs with sophisticated risk models failed to realize what in retrospect seemed obvious. They were dramatically over-leveraged. They never stepped back and said to themselves, hey, Even though the computer says this is okay, does it really make sense in real life? The ability to do this is not as prevalent among human beings as you might think. I believe the greatest risk control is common sense, but people fall into the habit of sleeping well at night because the computer said they should. They ignore common sense, a mistake I see repeated over and over in the investment world. Trait number 5. Great investors have confidence in their own convictions and stick with them even when facing criticism. Buffett never got into the dot-com mania, though he was being criticized publicly for ignoring technology stocks. He stuck with his guns when everyone else was abandoning the value investing ship, and Barron's was publishing a picture of him on the cover with the headline, "What's wrong, Warren?" And of course, it worked out brilliantly for him and made Barron's look like a perfect contrary indicator. Sixth, it's important to have both sides of your brain working, not just the left side, the side that's good at math and organization. In business school, I met a lot of people who were incredibly smart, but those who were majoring in finance couldn't write a worth damn and had a hard time coming up with inventive ways to look at problems. I was a little shocked at this. I later learned that some really smart people have only one side of their brains working, and that is enough to do very well in the world, but not enough to be an entrepreneurial investor who thinks differently from the masses. And on the other hand, if the right side of your brain is dominant, you probably loathe math, and therefore you don't often find these people in the world of finance to begin with. So finance people tend to be very left brain oriented, and I think that's a problem. I believe a great investor needs to have both sides turned on. As an investor, you need to perform calculations and have a logical investment thesis. This is the left brain. But you also need to be able to do things such as judging a management team from subtle cues they give off. You need to be able to step back and take a big picture view of certain situations rather than analyzing them to death. You need to have a sense of humor and humility and common sense. And most important, I believe you need to be a good writer. Look at Buffett. He is one of the best writers ever in the business world. It's not a coincidence that he is also one of the best investors of all time. If you can't write clearly, it is my opinion that you don't think very clearly. And if you don't think clearly, you're in trouble. There are a lot of people who have genius IQs who can't think clearly, though they can figure out bond or option pricing in their heads. And finally, the most important trait of all, the ability to live through volatility about changing your investment thought process. This is almost impossible for most people to do. When the chips are down and they have a terrible time not selling their stocks at a loss, they have a really hard time getting themselves to average down or to put money into stocks at all when the market is going down. People don't like short-term pain, even if it would result in a better long-term result. Very few investors can handle the volatility required for high portfolio returns. That doesn't mean financial education and reading and investing experience aren't important. Those are critical just to get into the game and keep playing, but those things can be copied by anyone. The 7 traits above cannot be copied. This was the letter by Mark Sellers that he wrote in 2007. The title is "So You Want to Be the Next Warren Buffett? How's your writing?" And I think this is a really interesting paper to think about and to review how you are positioned as an investor, what really matters for you to improve and what doesn't. If you need systems and a community of peers that help you stay on track on these 7 skills, strategysprints.com/JVC. This is where we do this every Monday. We help each other be the sharpest investor we can be and not to give up on your own systems, helping you building systems that you trust in every weather condition so that 20 years later you look as smart as Warren Buffett and you were not distracted by everything that's going on around you. See you in the next video.